Are you looking for safety whenever the market's hemorrhaging red? I don't blame you. I do too. And an ETF is a great way that people seek out a little bit of safety. But make no mistake about it, not all ETFs are created equal. And there are more ETFs than there are stocks being traded. So let's dive in a little bit and see if we can find one that might work out for us. Greetings, and salutations to you all, my brothers and sisters out there. Thank you so much for taking your time to tune in today. Like and subscribe to the channel. And we are going to look into a little bit of exchange-traded funds, the ETFs of the world. And it is true, there are more ETFs out there being traded than there are actually stocks, which is a crazy thought. And there is an ETF out there that's custom made for you. I don't care what you like, what you don't like, what your favorite thing is. There is a basket of stocks out there for you to trade. And that's just what an ETF is. If you don't know, an ETF is an exchange traded fund in which they collect a group of stocks of like-minded or kind of the same thought line of thinking stocks, put them all into one basket and you can buy into that. Now, it's a great idea because if you want exposure to, say, the semiconductor world and don't, want to trade exactly NVIDIA, or, if you want tech, exposure and you don't want to go in and dive into Apple and all the rest of them, you can just buy an ETF which covers all of the stocks. You have a wide encompassing net that gives you safety because they are the best of the best as a rule. So in the example of, say, the SPY is an ETF, or VOO is another ETF that really encompasses the best of the best companies in the stock market. And these companies even get rotated in and out. If it's not performing well, out you go. If you're performing well, you get inducted into the SPY or into the VOO or whatever the case is for the ETF, which is a great thing because you don't have to worry about dogs laying in there forever and dragging down. I mean, they may for a while, but they'll get rid of them. Much like you would rotate bad stocks out of your own portfolio, so too do they rotate these out of the ETFs. So it's a great way to kind of get a more safe play. But they're not all safe. They're not all created equal by any means. There are some that perform very well. There are some that flat out don't perform well, and there's some just get delisted. So, you kind of have to know what you're getting into. Just because you love something or love this or that about it doesn't necessarily make it a good play. And if you've been around the market long, just because it's a good company doesn't necessarily mean it's a good stock. So you really have to watch what you're doing when you're getting into these ETFs, just the same as you would a stock as well. But these are meant more for a little bit of a longer play. And there are some that are just really designed to be a flat out long-term play. And trust me, if you got anything, if you like dividends, some of these ETFs pay dividends. And there are ETFs just centered around dividend-paying stocks, high growth stocks, dividend paying, long-term, short-term, whatever the case may be. You've got one that fits into your line of thinking. Whether you like emerging markets maybe in Brazil or you like emerging markets in Korea, there's an ETF for that. If you like small caps, mid caps, large caps, whatever the case, there's an ETF for that. So you have a wide range of ETFs to get into that are fairly safe. It's not always, though, a set it and forget it thing. So let's look at exactly the ETFs that are offered and see what might be available that we can get into right now. The big dog ETFs on the block, there's 5 of them, but there's a top 25 list, and you by all means can look up, and many lists. But the top 5 ETFs, they encompass $3.8 trillion. They are huge companies, and they are rock solid. If you're going to have that much money tied up, you can better believe that there's going to be a solid play there. It's not going to be a rocket ship to the moon, but it's going to be a safe haven that you can get into and have some kind of reasonable sense that your money's just not going to go up in flames. The number one, the biggest ETF out there, and these are all by this size, not by, trading or any other moniker. It's just their AUM number. The number one is VOO. VOO is actually one of the very first things that I got into when I got into the stock market, because everybody said I needed an ETF. Everybody said I needed a safety net. So that's what I got into. VOO encompasses, the top 500 companies of the stock market. And just like I said, they trade in and out. If you're not doing well, you get out of the VOO. If you're doing well, they induct you into VOO. So it's been a solid play, and it's just, it just like the regular stock market, over time is going to go up, up, and up. This is a great play that if you're looking to just set it and forget it, if you're just putting money into it, if you are just putting money into your account every month to buy something, this would be a great play for you, just to absolutely dollar cost average, or just have that repeating a month after month after month, buying a little VOO. And just like VOO, if you prefer, you can have the SPY. The SPY is exactly the same thing. It's the top 500. IVV is also a very good top 500 company that, or investment. They all do the same thing. They've all basically got the same thing. So just a side note, if you've got VOO and SPY, or if you've got two of the same kind of growth ETFs, or whatever the case, in your portfolio, get rid of one of them. You don't need one of them. You just need one that does what it's supposed to do. And both of them, if you look at the top 10 holdings or their overall holdings, you're going to see it's a strikingly similar. So don't ever get doubled up on them. You also got VTI, which VTI covers a total stock market, encompasses the whole thing. So this is an all-encompassing one, as opposed to just the top 500 companies. And then we have our good friends, the triple Qs, QQQ, coming in at number 5. Of course, it leans more heavy into the tech sector, and also leans more into the NASDAQ, which is more of a tech-friendly exchange. So, but you also have great stocks in there, great ETFs in there, such as VUG, which is a growth. We have a BND, which is the bond market. We have GLD, which is the gold market. And there's this, the list goes on and on and on. But these are the top ones. These are the biggest ones. They may not always be the best to trade, but if you're looking for a long-term investment or something stable to keep your money in while you're looking for investments, this is a great way to go, because the stock market goes up over time. It goes up 8, 10 on a great year. Who knows, it could go up 12%. So it has recent times. So this is a great investment just to get your money in, and it pays a little tiny dividend. So it's a great opportunity for you. But you will see no leveraged ETFs in the top 25. You're not going to see any crypto ETFs in the top 25. There's just too much up and down, too much risk. They don't hold their value well, so they're not going to get into the top 25 until there's more stability in them. It's not that they can't, they're just not at this time. Now, the biggest ETFs you will see is not exactly what retail chases. Retail likes to chase different things. Yes, the SPY and QQQ are two of the common ones that cross over, but outside of that, you're not going to see a lot of things. This is where you're going to see a lot of your emerging markets, and in these really solid rock plays, like some kind of financial. But you can get in there, and if you lean more, if you want to do all the stock market, go to VOO. If you want to do financials or whatever case, you can kind of find your niche in there. But you will find that the retail customer, such as us, does not really chase those to trade. That's more of a put your money in, let it do its thing, and then check back in 10 years and 5 years and see how it's done. Or park a large amount of cash in there for a year until you're ready to get back into the market or something, and it's going to hold value well. So, the 1-year performance ETFs, they definitely belong to the semiconductors. If you're looking the 1-year ETFs, if you're looking for that performance, the semiconductor and AI trades absolutely are going to dominate that. There is absolutely no doubt. But what if we're looking about a 10-year performance ETF? Not that set it and forget it, but we're looking for a little more risk. We're looking for a little more rocky ride. We're looking for a little more action. Well, that's going to be a little different story. Yeah, semiconductors are still going to be in there, but there's a few more that make their way into it. When we look at these ETFs, the ones that really combine size and performance, you're going to see that the Qs rank as the number 13 in size and performance, just by what I looked up. I mean, they can fluctuate, whatever. I mean, don't hold me to 13, but you know what I'm saying. So 1, 3, 5, 10 years, they all have been dominated by semiconductors. They talk about, well, semiconductors are up or semiconductors are down or the semiconductor run over. Well, over the past 10 years, their run's not been over. And if you look at these things, they have just been running off the charts. You have the ones that we know, or maybe you are familiar with, like SOXS or SMH, but there's also one, you've got your PSI, XSD, and then in the tech sector, of course, you have your QQQ, but you have your IYM, you have your VGT, your FTech, XLA. I mean, there's all kind of different ones that you can really take a look at. And really, it's not something that you could just hear somebody say you should buy this one. You really shouldn't do that ever. You should never just take someone's advice blind that this is the best one. You really should look at it to yourself and see if it really suits your needs. Is it a high price one, and maybe you like the price a little bit lower? So you're thinking options. You're thinking, I get 100 shares of this, I can run options. Some ETFs are very good at running options, as we know. XSP, SPX, the SPYs, the Qs, they're all very good at running options on, or short trading, day trading, and these types of things. But there are others that are just absolutely flat out terrible for their options market. So it's really something you got to look into, to what style of trading you are, or what style of trading you're looking for when you're getting into the ETF itself. Those semiconductors have really monopolized the 10-year. You also have really nice, if you look at sectors, yes, semiconductors, but it breaks down a little bit further. Now you see healthcare making its way in there. Now you see financials making its way in there. What else we got? Oh yeah, we got energy making its way in there, materials. And all of these have beat the S&P over time for the investment. And that is a market that comes and goes. But over time, these have even beat the S&P, just because these things have been hot. They've got hot, they've stayed hot. But while you were looking at it, any consumer category, consumer discretionaries, the consumer staples, consumer services, whatever it may be, they all don't hold a candle to the S&P 500. So instead of putting your money in these consumer discretionaries or consumer whatever, it just makes sense that if you're looking to make money on this, you would have to put it in some other form. So, you might want to shy away from those. But if you have another reason that you're doing that, well, that's your reasoning. And don't ever go away from your reasoning. Stick to your guns. If it's working for you, keep it working for you. But as I said, there are a ton of special ETFs out there as well. We have all these set it and forget it, and these boring ones that we can get into that don't really provide a lot of action, but they do provide a lot of security, and they help you sleep at night. But there's a lot of them out there that are a lot of fun, and there's a lot of them out there that are a little crazy. So let's look at some of those. Maybe one of those are for you as well. Now here's where it gets a little shaky. These are dicey ETFs. These are the ones that can be delisted. These are the ones that may absolutely stink. They may lose money. And none of this has been financial advice whatsoever. I'm not a financial advisor. And you have to make your own decisions for your own money, because after all, it's your money to lose. So what we are talking about here is very risky. So keeping that in mind, maybe a 5%, or, if you're a real risque person, you want to put 10% of your buying power over there in that. Just be careful with what you're doing. Just be careful. A quick story, it's May the 4th, or it's right at May the 4th, and we're talking about May the 4th be with you. We're talking about all this Star Wars stuff. We're talking about May the 4th. And I come across Jedi, Jedi. Jedi is a drone and kind of modern warfare type of ETF. Well, hey, I'm having a glass of bourbon. It's May the 4th. I got Jedi sitting in front of me, so why not? I buy a few shares. It was at $26, I think they were. Jedi went up into the 30s, and I sold them out. But that's just kind of a fun thing. That's the fun thing. I've always been a Star Wars guy. Obviously so, and things. But, it's fun to do those kinds of things in trading, because trading can be so damn boring. It just bore you to tears. So it's nice to have a little bit of excitement in there, or something that's just fun to talk about. And one of those things for me was Jedi. But there's a ton of them. Let's say you like a vice. Let's say you have a vice. I just talked about bourbon. So maybe you might want to get into the ETF vice. It covers gambling. It covers sex. It covers alcohol. There's all kind of those things in it. You've got things like anything from Nvidia to Altria to British Tobacco. All these types of things are in there. That ETF you would think would just burn it down, just be going crazy. Guess what? It stinks. I don't know why it stinks, but it's you would think the vice, everybody's doing this. No one's giving these things up. Anybody, there's all these different sorts of things with gambling. No, vice is a terrible ETF, but it sure would be fun if it wasn't. And it would be a great one to talk about and trade, because people aren't going to stop drinking, gambling, and doing all these kind of crazy things. And that, hey, no shade here. But by all means, there are other ETFs in there. If you're looking for a liquor ETF, and if you're looking for one, maybe you like the airlines, maybe you're a traveler, you're like, oh, I fly all the time. Or maybe you just have to fly for work, unfortunately, racking up all those cool miles. But jets, 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 they are an ETF that just encompasses that. I mean, they're just in the aviation community. You've got things, if you're a cosmetic person, maybe you're a lady that's into that, or, or a guy, whatever, your cosmetic industry and all these kind of, maybe a little bit of health industry thrown in there. Be Fit. Be Fit may be one for you. We got clothing and sports with the MVP. We've got bets. We've got ones. Hey, you like junk food? We got one for you. What do we got? PBJ, of course. PBJ covers all your snack food and all these types of things. You've got real estate ETFs. One of them's Roof. I mean, they have all these cool names and there's all these cool things. But trust me, if you're into luxury cars, there's one of those for you. It's Lux, Lux. There is an ETF, trust me, for every kind of thing out there. So whatever you may be into, maybe you're into building, or maybe you're into the real estate pre-construction, or whatever, there's an ETF out there that will custom suit your needs. But just because you find it, don't buy it, because it may stink. It may not be a good ETF. It may be an ETF that's going to lose you money or get delisted, or it could be a bad day. But just look at them, look out into them. And I tell you, an ETF is a very good investment if you want to look at something for a long term, especially the solid plays like your small cap, large cap, medium cap, 500 encompassing companies, overall emerging markets. All these are very solid plays. They're very solid to get into, to park your money in, or leave your money in. If you're a 35-year-old investor, you absolutely 100% should be putting money into the SPY or VOO or some kind of full encompassing 500 right now. And you should also be doing a growth one as well. I recommend a growth one. I recommend the solid play as well. Those two are really staples that have to be in my account, especially if you're doing a Roth account or you're managing your own IRA. You just absolutely have to have those in there just for the stability of it all. Hey, sometimes whenever you see your account go down 10, 15, 20%, or what, maybe you had a bad case that you've lost half of your account whenever these red weeks happen or the market gets struck, these won't do that. These won't go down 1, 2, 3%. They may go down several days in a row, but they're not going to get hammered like individual stocks do. And if you're a put seller, or you live on the edge and selling risky options, they're risky, just by you could lose a lot of money because they're undefined. You really need some stability in your life. And a lot of these, as I say, you can run options on them. So if you're investing into the SPY, you can invest into the SPY and play options on it. Now, you may not have 100 shares of the SPY, but you can certainly do XPS, or you can do SPX, or any of them, XSP. All of those will work out for you, and you can be closely tied by having shares as well as running the options on it. Kind of a double up, if you will. But hey, those kinds of questions are the ones you have to answer. But ETFs, yes sir, the exchange traded funds, they are a great way to do it. They are a great way to get exposure to a stock sector that you really like, to get into stocks that you really like. Even if you like the Mag 7s and feel they are strong and they will continue to grow, then you need to get into a Mag 7 ETF, or if it's a good one. But watch out for the fees. That's how these people make money. They make money by their fees, and not all of them charge the same fees. Not even the S&P 500 VOOs. There's a little bit of difference on that. Do a little bit of math. If you're putting a large amount of money in it, it really can make a difference. So just watch out for the fees. Watch out for the long-term, the short-term performance, how they've been over time. Look at just the overall. Look at the history of them and look at their holdings. If the top 10 holdings are something that you're really interested in, then I say absolutely. You've done your research, pull the trigger. It's not anything that's a lifelong commitment. You can get out of it if you don't like it. But you'll notice we didn't talk a lot about the ones XYLD and these yield max and these types. And that's because these ETFs make their money by selling calls and by selling options on stocks. Well, you already do that. You don't need them to do that. You do that. So that's why, and they're super risky. That's why I kind of didn't mention them. And plus, they're not on the list anyway. But I didn't even touch on them because we already do what they're doing. And if you want to just mirror what they're doing, just look at their top 10 holdings, look at the stocks that they have, and just go with that. Sell options on what they're already doing. So, we don't need to pay them a fee and all of that to do what we can already do. So that's why they've been eliminated. The rest of them get a bunch of stocks. They hold a bunch of stocks that, we may not want to pay for all those stocks. So yes, ETFs, get in there, get familiar with them, put them into especially your Roth and long-term accounts that you have long-term holdings in. And hey, look forward to trading with these stocks, the ones that you can get in to have the good markets, the liquid markets that are a close, tight bid-ask spread, and enjoy them. Enjoy the heck out of them because they are a lot of fun. And they're a lot of fun if you find one that's really right up your alley. I appreciate your time today. Thank you so much for stopping in. I hope your portfolio health is so good. I hope you're doing so well. It's been a little bit of a rough July, which was really uncharacteristic, but hey, get those ETFs. They'll help stabilize your account. Thanks so much again for tuning in. Have a wonderful day, and we'll see you next time on Trading in Your Future.